Okay, we will start now. Okay. Hi, everyone. Thank you for joining me this evening again. It's great to have all you here. I'm James, market strategist at Tiger Brokers. Today, I'll be talking about Tesla, Amazon, and Apple. My topic is second quarter 2024 earnings preview. Can AI boost Tesla, Amazon, and Apple earnings? Again, we are giving out some lucky draw prizes as usual, so please stay with us for a chance to win the prizes. If you want to win these prizes, be sure to log in to your Tiger app. Basically, there are $2 stock vouchers for each of the 20 winners. If you are one of the winners, we will credit the stock voucher to your Tiger account within the next few days. To redeem it, simply go to the reward page under the profile tab and use the voucher when your stock order is executed. We'll be giving out these lucky draw prizes at the following timing. And I think they would intend to extend the timing as well, so they will giving out more than this. Let me go through some of the disclaimer first. This presentation is provided to you for education and sharing purpose only. It does not constitute to any form of advice. Past performance is not indicative of future performance. I will talk about upside catalysts and downside catalysts for Tesla, Amazon, and Apple, as well as the earnings expectations. Okay, first thing first, let's talk about Tesla. Tesla will report earnings on 23rd July after market close. The year-to-date return for Tesla is 1.67%, making it the worst performing stock among the Magnificent Seven stocks so far this year. However, Tesla recently attracted a lot of investor attention because the stock has risen by 69% since the first quarter 2024 earnings announcement. Another thing you may notice about Tesla is that most of the Magnificent Seven stocks are trading near the all-time highs, but Tesla is still trading about 38% below the all-time high. I guess this is one of the reasons investors find Tesla appealing, as they consider Tesla as the laggard among the Magnificent Seven stocks. Every Tesla investors should know that Tesla is currently between two growth waves. The first wave was driven by the initial release of Model 3 and Model Y, and the second wave is expected to start with the next generation vehicle platform. Tesla has not released any new models since 2020, so customers are losing interest in the older models, leading to a decline in sales itself. This is why Tesla needs to release new models as soon as possible. Ideally, these models could be based on the next gen platform, which is expected to save costs and significantly improve the profit margin. This is why Tesla said in the last earnings announcement that they would release new models early next year. This is why I personally do not expect much in terms of share price performance for Tesla this year, because people may be waiting for the new models to release before making purchases. Therefore, Tesla could potentially perform better next year, but maybe not this year. Let's do a quick earnings recap first. In the first quarter 2024 earnings report, both revenue and earnings fell below expectations. The operating profit margin declined to just 5.5% in the latest quarter from 8.2% one quarter earlier. Here, I also like to show you some of the delivery forecasts by analysts from January. However, analysts have not provided any update recently. I believe the main reason is that their focus has shifted from deliveries numbers to the launches of robotics, the next-gen platform, the new car models, and robotaxi. Or maybe the analysts themselves simply do not expect any delivery growth this year. But let's talk about the car delivery numbers first. Tesla announced the delivery numbers at the beginning of this month, and it is pretty bad as it declined by 5% year on year in the latest quarter. And in the past 10 quarters, Tesla consistently missed estimates. Only 4 out of 10 times the delivery numbers beats estimate. However, Tesla latest car delivery numbers beat the expectation by 1%, which was quite a relief for investors. Despite only beating by 1%, is successfully excited many Tesla investors, and the share price jumped by 10% on that day itself. The latest delivery numbers also show that Tesla is still the world's largest EV seller. Tesla sold about 443,000 cars in the second quarter, whereas BYD only sold 426,000 cars in the same quarter. It looks like BYD is catching up and may outsell Tesla soon. However, this does not necessarily make BYD a good investment. Why is that so? Because BYD does not disclose the profit margin for its EV business. So it's difficult to assess the profitability for BYD. On the other hand, Tesla should still be the most profitable EV maker in the world, even with an operating profit margin of just 5.5% itself. Now let's look at the earnings estimate. We already know the delivery number. So what remains uncertain is the revenue, earnings growth, and profit margin. Unfortunately, based on Bloomberg consensus, currently analysts are projecting lower year-on-year growth for Tesla in terms of the earnings per share, revenue, and operating profit itself. We also would like to look at the revenue and operating income forecast first. Currently, analysts are quite optimistic as they project the revenue and operating income will be higher than the last quarter itself, indicating a quarter-on-quarter increase and suggesting the worst could be over for Tesla. For example, in the first quarter, Tesla revenue was 21 billion and operating income was 1.1 billion. This quarter, they expect 24 billion in revenue and 1.8 billion in operating income. In terms of the year-on-year growth, analysts are expecting negative 2% growth for revenue and negative 22% year-on-year growth for operating income itself in the second quarter, which are better than the first quarter. The first quarter year-on-year decline itself is super serious. So all in all, they expect Tesla to start seeing year-on-year growth in the third quarter, which is the September quarter this year. We also like to look at the profit margin. The gross profit margin is expected to stay quite flat at 17.45% this quarter, whereas the operating profit margin is expected to increase from 5.5% in the first quarter to 7.69% in the second quarter itself. Personally, I think the gross profit margin and operating margin forecasted by the analysts might be a bit conservative, and I would expect some upside surprises this quarter. Let me share with you why. Okay, the main reason is the energy generation and storage segment. I expect we may see an increase in the revenue and gross profit of the energy and storage segment. Probably let me take some time to explain this. So currently, energy and storage accounts for about 8% of the total revenue. And in the delivery numbers announcement earlier this month, Tesla also mentioned they distributed 9.4 gigawatt hour of energy storage in the second quarter this year. So marking an all-time high deployment. Basically, the year-on-year increase itself is 154%. This also means that the deployment in the first 2 quarters this year is already 91% of what Tesla has achieved for the entire year last year. So as a rule of thumb, when deployment increases, the entire revenue of energy and storage segment should also increase. In the best case scenario, revenue growth for this segment could potentially increase by 154%. However, it does not always work out that way. For example, last quarter, when the energy deployment increased by 4%, the revenue increased by 6.9%. And we could also see that in the first quarter 2023, when energy deployment increased by 360%, revenue only increased by 148% itself. Okay, I believe energy and storage segment will certainly help increase Tesla overall gross profit margin and operating margin. The question now is by how much and whether it can significantly offset the revenue loss from the EV sales or not. This is probably something I will closely monitor during the earnings call next week. In any case, energy and storage are becoming increasing important to Tesla. In the fourth quarter 2022, the revenue contribution from energy was only 5%, which has increased to 7.7% in the first quarter this year. So the energy segment also enjoy the second highest profit margin at the moment. The latest gross profit margin for this segment is 24.6%, which is 7.2 percentage points higher than the EV business itself. I believe the gross profit margin can go even higher, especially considering the competitors Enphase is enjoying a gross profit margin of 44% in the same quarter this year. So all in all, as I mentioned in my previous webinar, earnings result itself is not important probably for Tesla because Elon Musk himself knows how to boost the share price. He has made some ambitious promises in the latest earnings report, resulting in a 69% increase in the stock price. Personally, I believe he could repeat the same strategy this quarter. For example, if the earnings result is disappointing, he might unveil exciting news such as the next-gen platform, robotaxi developments, potential Tesla launch in in India itself, humanoid robots, or maybe achieving 25% voting control. And let's take a look at some of the downside catalysts. Firstly, potentially lower profit margin due to Tesla ongoing price cuts in the EV market. Secondly, I believe FSD, full self-driving technology, is still a few years away from achieving level 4 or level 5 autonomy. Thirdly, Elon Musk may face challenges in securing 25% voting rights he desires. I also foresee slower delivery growth ahead due to reduced demand and diminishing benefits from the price reductions itself. So personally, I think the greatest risk is that Elon Musk may not obtain the 25% voting rights. Recently, no one has been talking about it, but I believe Elon Musk will pressure the board members to grant him the 25% voting rights after he receives the 56 billion pay package itself. Another significant risk to consider is that Elon Musk may still not be able to secure his 56 billion pay package. In June, if you remember, shareholders voted and approved Elon Musk's 56 billion pay package. And now Tesla will challenge the judge again in a hearing in the coming weeks. However, it's important to note that the hearing itself will not consider the shareholder vote in June supporting the pay package. So if Elon Musk does not receive this $56 billion, I believe Tesla stock will tank. Other than that, additionally, the US and EU may change the EV policies and delay the phase out of ICE, the internal combustion engine itself. Lastly, it also appears that Donald Trump may win the US presidential election. And if Trump wins, he may kill the US EV tax credits, the 7,500 tax credit itself, because he does not believe in EV. Okay. Initially, Tesla also scheduled to unveil the robotaxi in August 8. However, recently there have been rumors suggesting that Tesla may delay the robotaxi review until October. And yesterday night, Elon Musk confirms that the robotaxi will be delayed and there is no new launch date yet. But I guess we may hear Elon Musk talking about it, talking about the new date in the earnings call next week. I think the correct way to look at the news itself is that you should not be too hopeful about the robotaxi. There are a couple of reasons for this. Firstly, Elon Musk has failed to deliver on his robotaxi promises before. In 2019, he stated that the robotaxi would launch in 2020 with over 1 million on the road. But this did not happen. Secondly, Tesla autonomous driving technology is currently at level 2. And it likely will take a couple of years to advance to level 4 or level 5. In my best case scenario, it could probably take 2 to 3 years. And let us talk about the potential upside catalyst for Tesla. So firstly, Tesla may surprise all of us with better than expected earnings result. Secondly, Tesla announced in April that it will launch new models, including a low-cost model in early next year, which is sooner than expected. However, due to this faster timeline, these new models will be produced on the Tesla existing manufacturing lines using a mix of the current and next-gen platforms. So this would result in less cost reduction than initially anticipated. Thirdly, the unveiling of the robotaxi could also surprise all of us. Fourthly, there is potential for the Cybertruck to become profitable next year. So Elon Musk has mentioned it could achieve positive cash flow at some point next year. So some investors are optimistic about this. I am not that hopeful because if you have heard it from the news, there are 4 Cybertruck recalls since the launch. So this actually indicates high manufacturing complexity. I personally think that profitability may take longer for Cybertruck, and Bloomberg estimates the cost of producing each Cybertruck at about $115,000, about double the selling price of $61,000. But Tesla again may surprise all of us if they can ramp up Cybertruck production. And I also think that Volkswagen Rivian deal itself has made investors appreciate Tesla more. So essentially, the deal itself creates a 50-50 partnership. So Volkswagen gains an EV operating system and the engineering required to operate it, while Rivian received the funding and the benefits from Volkswagen's experience in the car productions. However, the deal itself also highlights the legacy automakers like Volkswagen, Ford, and GM may lack the competitive edge itself to compete with Tesla. So for instance, Tesla possesses advanced centralized electrical architecture, innovative modular assembly, and vertical integration of the supply chain. Therefore, the deal itself has made investors realize that Tesla might still be the best EV maker poised for success itself. Another catalyst is the next gen platform. So we all hear from Tesla that Tesla previously said that the next gen platform could reduce the production costs by 50%. However, according to Bloomberg estimate, the new unboxed approach may only cut the production cost by 33% in 2027. Currently, Tesla has not provided a specific launch date for the unboxed approach, but again, Bloomberg estimate it will only be launched in 2027, but has indicated that the new models next year will incorporate certain aspect of the next gen platform itself. Tesla could also start selling the humanoid Optimus robot by 2025. Again, the robot has a massive total addressable market. Goldman Sachs predicts that the global market for humanoid robots could reach 38 billion by 2035. And according to Elon Musk himself, the Optimus robot could potentially make Tesla a $25 trillion company. Keeping in mind that the largest company in the world now is Apple. Apple is currently sitting at a 3.5 trillion market cap. And one significant catalyst is the FSD take rate. While Tesla ultimate game plan here is to sell as many cars as possible at a lower price, and then improve the profit margin by selling them the autonomous driving software FSD. This is why Tesla has recently trying to shift investor attention towards FSD itself. And analysts are also working hard to estimate how the self-driving segment which include the FSD and the robotaxi, could boost the revenue. But currently, the global EV demand is not performing strongly, and Tesla has not yet launched the low-cost model and robotaxi. So you should not get too excited about the FSD take rate as well. Okay, let's talk about the technical analysis. So in my previous webinar, I mentioned that the strongest support would be 106 and 107 range. Currently, Tesla stock price has since shoot up to 140 something, shoot up about 69% from 140 something dollars since the last earnings announcement. And recently, you can see that yesterday closing price was $252 itself, after hitting the resistance at $265. And the next support level is 219. Personally, I don't think that there is any catalyst for the prices to trend higher based on technical analysis. Probably the better approach here is to wait for 219, 173 and below. But again, Elon Musk being Elon Musk, maybe he can surprise all of us in the earnings call next week. So the Bloomberg analyst consensus 12-month target price for Tesla is $203.74, representing an downside potential of 19%. So the Tesla valuations itself varies significantly depending on how analysts factor in FSD take rate, Optimus, robotaxi, and dojo computing. To put it simply, if you believe that none of the AI initiatives will succeed, you should not invest in Tesla. However, I believe that Tesla deserves a place in an aggressive portfolio. Personally, I think the correct strategy is that investors still need to gain some exposure in Tesla. If any of these AI initiatives succeed, they could potentially add hundreds of billions to Tesla market cap. And despite a weaker near-term earnings outlook, I still maintain a long-term constructive view on Tesla. So Tesla may remain the worst performing stock among the Magnificent Sevens this year. We should probably look at 2024 as a transition year for Tesla. Nevertheless, I view any weakness in the share price as a good opportunity to accumulate for the long term. Okay, now let's talk about Amazon. Amazon is expected to report earnings on the 2nd of August after the market close. Okay, Amazon is one of my favorite Magnificent Seven stocks. So the year-to-date return for Amazon is 28%, but in terms of the 3-year annualized performance, it is the worst performing stock among the Magnificent Seven at only 2.55%. In comparison, Tesla 3-year annualized is 5.57%, Apple is 17.65%. So Amazon is not performing well post-COVID relative to the peers. And if I need to blame it on one thing and one thing only, that would be the overexpansion during the COVID period. Okay, let me quickly go through the last earnings result for Amazon. So Amazon beats expectations across all key earnings metrics, earning per share, revenue, advertising, and AWS. Some of the important points you should know are, okay, firstly, Apple say that the cost optimization are tapering off. This means you probably should not expect much increase in profit margins due to the cost-cutting measures. Secondly, generative AI will generate billions in AWS revenue this year. And CEO Andy Jassy also expect that the AI business search itself could last for 10 to 20 years as customers adopt the technology. However, he did not specify the exact amount or percentage of the AI's contribution to the AWS revenue itself. So here are some of the earnings estimate for the second quarter by Bloomberg Consensus. Generally, the forecasts by analysts are within the company guidance, but at the higher end of the range itself. For example, Amazon projects revenue to be between 144 billion and 149 billion. Analysts are expecting 148.7 billion. Amazon projects the operating profit to be between 10 and 14 billion. Analysts are expecting 13.755 billion. So having said that, as long as Amazon can beat its own guidance in the earnings result, it would also beat the analyst expectations. So let's look at the earnings forecast. Okay, the revenue itself is expected to grow 10% year on year in the second quarter this year, and the operating income is expected to grow 79% year on year. So the operating profit margin is expected to decline to just 9.25% this quarter compared to 10.68% one quarter earlier. So interestingly, 10.68% is also the highest operating profit margin Amazon has ever achieved. Okay, something to note is that Amazon usually does not like to be too profitable. In the past, when Jeff Bezos thought that the operating profit itself was too high, he would incur a lot of capex to bring down the operating margin. I reckon the main reason for that is that he likes to incur a lot of capex to build sustainable profit and cash flow rather than focusing on the near-term profit itself. However, if the high profit margin you see nowadays is here to stay, and if Amazon CEO Andy Jassy surprises all of us by maintaining this high level of profit margin, I would say that Amazon stock could shoot up higher from here. Okay, let's look at the earnings breakdown. Okay, let me share with you some of the important takeaways. So firstly, the third-party seller services, advertising, Amazon Prime subscription, and AWS have all shown double-digit year-on-year growth for the 8 past consecutive quarters. So these are the major revenue growth driver for Amazon. Okay, they together accounts for 57% of the total revenue. Secondly, the first-party online sales, which account for 38% of the total revenue, grew only 7% in the first quarter this year. Essentially, I reckon that Amazon does not aim to make a profit in the first-party online store. Okay, I believe that the gross profit margin in the first-party online store is very low because Amazon's objective here is to ensure that it has the most items listed on the platform at the competitive prices so that people will patronize Amazon more frequently. When they want to look for something, they will go to Amazon naturally every day. Therefore, investors should not focus too much on the first-party sales, but should pay more attention to the third-party sales itself, which is performing quite well. So the year-on-year growth for the third-party sales is about 16%, contributing to about 24% of the total revenue, making it the second highest segment now. Okay, let's look at the e-commerce business. So currently the most promising market is India. So Amazon has about 335 million monthly active users globally. About 44% of them comes from India. Followed by US. US accounts for about 20% of the total monthly users. And Amazon is the second largest e-commerce player in India now with a 30% market share. So Amazon actually trailing behind Walmart, Flipkart in India. Okay, and India also has an e-commerce retail penetration rate of just 4.3%. Yeah, the penetration rate is just 4.3% in India. So indicating massive opportunities in the country. Other than India, the most important market for Amazon is still US. About 70% of Amazon GMV, gross merchandise value, is in the US, where Amazon holds the largest e-commerce player position with a market share of 30%. And it's estimated that the global GMV will grow at a CAGR of 14% between 2022 and 2027. So therefore, I like Amazon because of the growing GMV itself. Currently, we also notice that about 65% of the Amazon GMV comes from the third-party sales, and it expected to grow to 70% by 2027. Therefore, I would say that I expect double-digit revenue growth in the third-party sales for many quarters into the future. Okay, thirdly, the year-on-year growth for AWS is about 17% in the first quarter this year, lagging behind the Google Cloud 28% and the Microsoft Azure 31% during the same quarter. However, if you were to look into the operating income, the year-on-year growth for AWS is quite impressive at 84%, and the operating profit margin for AWS is 37% in the first quarter this year. In comparison, Google Cloud operating profit margin was just 9.4%. Most impressively, AWS currently accounts for 17% of the total revenue, but contributes to 62% of Amazon total operating income. So Amazon AWS is still the largest cloud player with 31% market share, followed by Microsoft Azure at 25%. Moving forward, AWS will be the key revenue driver for Amazon because generative AI itself will benefit cloud players like AWS by increasing demand for computing power and storage itself. Okay. These are some of the downside catalysts. So firstly, analysts expect that the Microsoft Azure could overtake AWS to become the largest cloud player by 2026. I believe it's possible. So some investors would argue that, okay, Microsoft Azure is a better cloud player to gain exposure to the cloud computing industry. But I reckon that the correct strategy here is maybe to own both Microsoft and Amazon to gain exposure to cloud computing. A couple of reasons for that. Okay, firstly, Microsoft never truly discloses the profit margin of Azure. So Azure itself may not be enjoying the higher profit margin similar to Amazon AWS. Secondly, the cloud computing total addressable market is huge. I believe it could accommodate these two major cloud players itself. Okay, the second downside risk is an antitrust lawsuit. Trade Commission is suing Amazon at the moment for illegal monopoly practices. But it will only go to trial in October 2026. But this would be an overhanging risk for Amazon. And another downside risk would be the intense e-commerce competition. So the e-commerce business is lucrative. So constantly it's attracting many new players like Temu, TikTok, and Shein. On top of that, the e-commerce business is cyclical. So recently, the US e-commerce market has been attracting many Chinese players like Temu, who sell products from China at extremely low prices. And to compete with these Chinese players, Amazon intends to launch an online storefront for low price products in the next few months. And it will also ship products directly to customer from China. So this approach may erode Amazon profit margin, but the asset impact is not yet known. And in the US, as long as you send a parcel as long as you send a parcel worth less than $800 directly to US from abroad, there will be no tax duties. There will be no import tax. This is called de minimis in US. So US intends to close this tax duty loophole itself. I believe US will likely do that. And we could also see that Brazil recently imposed 20% tax on the international purchases of up to $50. And Europe is also consider imposing an import tax on low-cost items from Temu and Shein as well. So I guess maybe the US can take a page from the EU and Brazil. I think if the US can successfully ban TikTok, then it could probably impose a tax on Temu and Shein as well by cracking down on this de minimis loophole itself. So here are some of the upside catalysts for Amazon. Margin expansion would be the key investment thesis, especially the cost optimization is tapering off. So hopefully generative AI could further push the profit margin higher. Okay, I did not share much about the advertising revenue, but advertising is something to look forward to. Currently, Amazon is the third largest advertising platform in the US. And I reckon that Amazon may announce dividend and share buybacks in the near future because there is massive free cash flow now. The trailing 12-month free cash flow is now 50 billion US dollars in the first quarter when you calculate that. Okay, let me share a bit on the technical analysis. So I see a major resistance level at 204 and 205 price level. The other major resistance levels would be 238, 255, 281, and 301. And these are some of the support levels. Okay, the current consensus indicate that the 12-month target price for Amazon is $222.61, representing an upside potential of 15.5% relative to yesterday's closing price of $192.72. I reckon that Amazon has been widely viewed by the consumers and the market as falling behind on the AI. So a lot of investors are under investing in Amazon now. So this is why Amazon is investing $4 billion in AI startup. Anthropic, in return, Anthropic grants Amazon enterprise customer access to Anthropic Claude, if I pronounce it correctly, which is one of the leading generative AI model. Hopefully, we could hear good things about the Amazon generative AI soon. All in all, Amazon is a margin expansion story. If Amazon can maintain the profit margin at this level or at higher levels, then the stock price will be higher from the current price. In short, I am long-term constructive on Amazon. Okay. Okay, next, I also like to talk about Apple. Apple will release the latest earnings result on 1st of August. It is still my favorite company among the Magnificent Seven stocks. Okay, many investors might reckon that since Apple has increased by about 19% following the WWDC AI announcement, so Apple is quite expensive now. However, despite the year-to-date return sitting at 22%, Apple remains the third worst performing stock among the Magnificent Seven. In comparison, Amazon has returned about 26%, Meta 40%, and Google 33% so far this year. Okay, let me do a quick earnings recap. Apple earnings result in the second quarter this year, which is the end March quarter, beat expectation. Both revenue and earnings per share beat expectations. Most importantly, iPhone revenue and services beat expectations. Additionally, Apple also announced the largest ever 110 billion share buyback to boost the stock price. Okay, the main concern for Apple is always the iPhone sales, because iPhones account for about 50% of the total revenue for Apple. And here are the global smartphone shipment figures for the second quarter in 2024. We could see a 6.5% year-on-year increase in the global smartphone shipment during the second quarter. However, Apple growth was just 1.5% year-on-year, and its market share dropped to 15.8% in the second quarter from about 17% 1 year earlier. Okay, I believe the main reason for this is the uneven recovery in the Chinese economy, where the lower-end smartphone, like those from Xiaomi and Vivo, are selling better due to the cheaper prices itself. But you probably should not worry too much about the iPhone shipment now. Investor I would say investors nowadays do not care much about the iPhone sales at the moment. Their focus is likely on whether the launch of the iPhone 16 in September this year will significantly improve the sales or not. And I reckon that a lot of investors have been focusing a lot, probably too much, on the China iPhone sales. To me, the main battlefield is probably not China, but India. India still has a smartphone penetration rate of just 46%. So India could be an exciting market for Apple in the next 10 years. The Apple iPhone currently has the largest market share by revenue in India. The market share was 17% in 2022 and has now increased to 23% in 2023. And in terms of the ultra premium segment, in the first quarter, Apple has a commanding market share of 69%, followed by the Samsung at 31%. And currently, India is the 5th largest market for Apple, ranking behind the US, China, Japan, and the UK. But India is expected to become the 3rd largest market for Apple by 2026. And this is the latest personal computer shipment in the second quarter this year. Overall, the PC shipment increased by 3% year on year. Apple MacBook increased by 20.8% year on year in the latest quarter itself, but you could see that overall the PC shipment only increased by 3%. And Apple PC market share is now sitting at 8.8% in the latest quarter compared to just 7.5% in the same quarter 1 year ago. However, investors again should not get too excited about the news because MacBook itself only accounts for about 8% of the total revenue for Apple. So here are some of the earnings estimate for the third quarter according to the Bloomberg consensus. Generally, the forecast for the end June quarter is quite decent. The year-on-year growth itself are mostly slightly positive. Here are the revenue and operating income estimate. So revenue is expected to increase by 2.68% year-on-year in the third quarter, which end in June. Operating income is expected to increase by 6.4% year-on-year over the same period. It's not bad considering there was negative year-on-year growth in the second quarter itself. However, analysts are still expecting low single-digit year-on-year growth in both the revenue and operating income for June quarter and September quarter this year. Okay, the gross profit margin is expected to slow down to 46% compared to 46.58% we saw in the previous quarter. Operating profit margin is also expected to decrease from 30.74% in the last quarter to 29% this quarter. However, you should not worry too much as well because the gross profit margin and operating margin are still projected to be higher than in the same quarter 1 year ago. Okay, one silver lining for Apple is the service revenue. So the service revenue itself now accounts for about 26% of the total revenue. And in the second quarter this year, it hits an all-time high of 23.8 billion. So it has been enjoying double-digit year-on-year growth for the last 3 quarters, and the gross profit margin for services also grew by to an all-time high at 74.6% itself. So basically, I expect the revenue from services will help offset some of the decline in the product segment. We could see that the product segment has not been doing quite well since the first quarter 2023 itself. So I would say that you should not expect products to do well in the June quarter and September quarters, because the new iPhone 16 will only be released at the end of September. So we probably only expect some product growth driven by the iPhone in the December quarters. But again, the December quarter earnings result will only be released in January next year. So most likely, investors and analysts are trading in the blind, betting that the new iPhone 16 sales will be good. So here are some of the upside catalysts. I reckon that the strong ecosystem of Apple has created over the years should offset any short-term negative growth, and India is likely to remain the fastest growing market for Apple in 2024 and 2025. And there are some excitement in the AI PC that I think Apple would benefit as well. But again, you should know that 50% of the revenue comes from Apple iPhone sales. So investors always talk about iPhone, always focus on the iPhone sales itself. Basically, the main investment thesis for Apple now is that the new iPhone 16 launched in September should be selling well. So according to Bloomberg News, Apple recently told the suppliers to plan for 10% increase in the iPhone shipments after the iPhone 16 launch in September. So the rumor itself only came out last Friday. So I guess a lot of analysts will be revising the iPhone shipment targets upward, because previously they only expected a 5% increase in the new iPhone sales itself. So we should be seeing a new iPhone's upgrade cycle driven by the Apple Intelligence, AI. So what is Apple Intelligence? Apple Intelligence is similar to Microsoft AI Assistant Copilot, but you can access Apple Intelligence for free. So to put it simply, Apple Intelligence aims to assist you in using your Apple devices more easily. Okay, some of the key Apple Intelligence features that I will see myself using include, firstly, Siri. Siri will be able to perform many tasks for you, such as answering your queries using information from across apps. Secondly, writing tools. Basically, writing tool will help you rewrite, proofread, and summarize text itself. And I reckon it's more natural for iPhone user to use writing tool than ChatGPT, because writing tools are available system-wide. Unlike ChatGPT, if you need to use ChatGPT, you need to open a ChatGPT app or browser to access to the ChatGPT itself. But you can use writing tools anywhere on your iPhone. So Apple Intelligence can only be run on Apple iPhone 15 Pro, which was launched last year, and all the latest iPhone models launching this September, and on Mac and iPad devices using the M1 processors or later. Okay, so this is one of the most important slides. having said that, there is limited group of iPhone user who can access to Apple Intelligence. Approximately 1.46 billion people worldwide are using iPhone this year, which means around 18% of the world population are iPhone user. But about 8.2% user are using iPhone 15. Therefore, you could say that more than 90% of the iPhone user do not have access to the Apple Intelligence AI. According to a separate research by Jeffries, they estimate that there are only about 4% of the current iPhone user will have access to Apple Intelligence. So an upgrade cycle is possible, especially considering about 43% of iPhone users are using the older version like iPhone 12 or older. I reckon Apple has offered just enough AI features for Apple users to upgrade their devices. So these are some of the downside catalysts. Okay, slow iPhone sales, especially in China market. Apple Vision Pro sales are much lower than expected in the US, but recently they also started selling in the international market. So we could probably expect some upside surprises in coming quarters and more regulatory scrutiny. Okay, let's talk a bit on the regulatory concern. So last week, Europe announced that iPhone users in Europe will no longer have to use Apple Pay as the only mobile payment options. So iPhone users can now use their preferred mobile wallets for payment in Europe. And Apple also recently announced that European customers will not get access to Apple Intelligence features because iPhone will not include the Apple Intelligence features in the European Union in 2024 due to the regulatory uncertainties surrounding DMA. Bear in mind that European countries account for about 16% of iPhone sales, so this could potentially be a big concern. And US Justice Department recently sued Apple, saying that Apple makes it difficult for competitors to integrate with iPhone. So again, no one knows how serious this news is, but the lawsuit itself may only last. The lawsuit itself may take a couple of years to arrive at a conclusion. So Apple is trading at Apple is trading at $234.4 at the moment. So these are some of the support and resistance level based on the Fibonacci resistance levels, retracement levels. So major resistance include 236, 263, 277, and 298. So based on the flat pattern, I think Apple may potentially go to $277 first before facing major resistance. So the current analyst consensus 12-month target price for Apple is $221.31, representing a downside potential of 5.6% relative to yesterday closing price of $234.4. Okay, personally, I will not read too much into the target price because analysts still struggle to understand the growth in the new iPhone sales expected in December. Okay, to put it simply, the main investment thesis for Apple is the Apple Intelligence is pushing for a new upgrade cycle. Apple now has the largest install base in history and the longest delay upgrade cycle. which means the longest period iPhone users have not upgraded their iPhones. Apple has not introduced anything exciting, or you can say as exciting as Apple Intelligence for a long while. So this is why I reckon we may see a multi-year iPhone upgrade cycle. Additionally, less than 10% Apple devices can currently run the Apple Intelligence. So if you believe that the September sales of the new iPhone 16s are going to be good, Apple stock at the current price would still look attractive. Okay, probably let me do a quick recap of all the stocks I mentioned today. Okay, the main investment thesis for Apple is an iPhone upgrade cycle. As for Tesla, I believe 2024 is a transition year. There is no urgency to gain exposure to Tesla this year because all the growth should only start to realize in 2025. But if Elon Musk continue to provide insane promises to investor on Twitter or earnings call, then I think Tesla stock price will go higher this year. For Amazon, I believe the benefits from cost optimizations are tapering off. So you should not expect much from the margin expansion due to the cost savings. However, the growth in the generative AI might be just in time to push the profit margin higher. So if you believe in the growth of generative AI, Amazon is still one of the best AI players out there. In conclusion, I believe all of these three stocks that I covered today are long-term beneficiaries of AI. This is why I believe they all deserve a place in the portfolio. So lastly, I want to show you the forward PE ratio of these seven stocks, the Magnificent Seven stocks. So all of them are quite expensive at the moment. For example, the PE ratio for Apple is 33.8 times, Amazon is 32.6 times, Tesla is 94.5 times. However, investors are willing to apply a higher PE ratio for AI-related stocks. So everything related to AI now is expensive. Currently, I also believe that the AI will kickstart a new earnings growth cycle, similar to what happened to NVIDIA in the past 1 year. So unless earnings really miss expectations for 2 to 3 consecutive quarters, then I might have some doubt about my own optimism regarding AI. Until then, I believe the valuations of all these AI stocks are justified. Okay, that will be all for me. If you have any question, let me know in the chat room. Okay, let me see if there's any questions. So probably let me wait for a few seconds before I close the webinar. Okay, I believe that there is no questions. So thank you all today. Happy investment, happy trading. Thank you. See you next time. Bye.